Yolanda, please go ahead.
Hi, good afternoon, everybody.
Okay.
Good afternoon. Welcome to the release of the Financial Stability Review. I'd like to welcome our panelists, our governor and our deputy governors. I'd also then like to hand over to the governor to welcome all our guests on our multiple forums on this launch of this Financial Stability Review. Governor, over to you.
Good afternoon, members of the press, guests, colleagues, ladies and gentlemen. Welcome to the second Financial Stability Forum of 2021. The intention of the forum is to enhance public debate on issues relating to financial stability. The forum happens twice a year and coincides with the release of the SARB's Financial Stability Review document. The SARB has got a constitutional responsibility to maintain price stability and a statutory responsibility to maintain financial stability. This responsibility does not only entail an assessment of vulnerabilities in the financial system and potential mitigating actions, but also makes financial sector participants and the public at large aware of the risks and vulnerabilities that the SARB identifies. The Financial Stability Review is the primary channel through which this communication is done. Since the publication of the previous review in May this year, the outlook for financial stability has somewhat improved. South Africa's GDP growth has been stronger than expected, benefiting from favorable global and domestic conditions, while the rebasing of the GDP numbers by Statistics South Africa also improved some of the key ratios. However, global growth concerns alongside domestic structural challenges such as electricity constraints and high unemployment levels are expected to negatively affect the domestic economic recovery. The temporary support measures to the economy and financial sector that were taken in response to COVID-19 have substantially lessened the impact of last year's economic recession on the financial system. But as support measures are gradually being unwound, the impact of COVID-19 will continue to be felt. Lockdown measures have continued intermittently as new variants of the virus emerge and as vaccination rates remain well below what is required to reopen the economy fully. The low economic growth experienced during the COVID-19 pandemic is weighing on credit growth and profitability in the financial sector. In 2021, the unemployment rate continued to rise, fixed investment moderated further, and unrest caused material damage to property and investor confidence. Partially, as a consequence of these pressures, growth in credit extension to the private sector recently turned negative on a year-on-year basis. While measures of profitability among banks and insurers have recovered from their 2020 lows, many remain below pre-pandemic levels. Subdued profitability expectations make financial firms reluctant to take on additional risk that is associated with new business growth opportunities. While this is responsible behavior from a risk management and stability perspective, it could also dampen growth supportive activity in the financial sector. The nexus between the financial sector and the sovereign is also likely to remain a key risk to financial stability over the medium term. The exposure of domestic financial intermediaries to government remains elevated, while public debt is projected to grow further over the medium term. The Financial Stability Review presents a detailed analysis of these and other potential vulnerabilities in the domestic financial system. Overall, however, the South African financial system has displayed a relatively high level of resilience under very challenging conditions. In this edition of the Financial Stability Review, we present the results of solvency and liquidity stress tests undertaken on South Africa's six largest banks. The findings indicate that even under the adverse scenario of a double-dip recession, these banks are expected to maintain an aggregate level of capitalization and liquidity above the minimum regulatory requirements. I am now going to turn over to Vafa Anwari, who will take us through a presentation of the key messages that are captured in the Financial Stability Review. At the end of the presentation, there will be an opportunity for questions, which we will then direct to members of the panel. Yolanda.
Thank you, Governor. Vafa, over to you for your presentation. And then when you're done, you can hand over back to me so that I can do the Q&A session. Thanks, Vafa. Go ahead.
Thank you, Yolanda, and thank you to the Governor. And good afternoon to everybody joining the broadcast today. So as mentioned by the Governor, I'll be taking you through a couple of the key messages from this edition of the Financial Stability Review, several of which he's just covered in his opening remarks. First and foremost, the financial stability outlook has improved since the publication of the previous Financial Stability Review roughly 6 months ago. And this is in line with a recovering economy. We are also witnessing financial institution profitability that is improving after a challenging 2020, although we may not see them return back to pre-pandemic levels just yet. A key highlight from the current Financial Stability Review is a chapter dedicated to the stress tests that were conducted by the SARB on the banking sector over the course of 2021. Outcomes from this exercise suggest that the banking sector will remain adequately capitalized in the event of a double-dip recession. However, we cannot lose sight of current risks, several of which have just been mentioned. These include elevated debt levels, which remain relatively high, and also the associated debt service costs that come with it, the high level of interconnectedness between the financial sector and the sovereign, and the ongoing risks posed by COVID-19, especially towards the fledgling economic recovery that has been improving over the past 6 months. So on that note, I'd like to start with a look at current financial stability risks. So the South African Reserve Bank produces what's called a risk and vulnerability matrix, which we used to refer to as a risk assessment matrix. Risks in this matrix are categorized according to their likelihood, their level of vulnerability that they pose to the financial system, and the time frame over which the risk is likely to be realized. So if we start with the first row of risks here, the high likelihood risks, first and foremost, we have the further COVID-19 flare-ups, the possibility of a fourth and potential further waves of COVID-19 infections, which will be probably brought about by relatively low levels of vaccination in the country, and the potential restrictions on economic activity that will come with them, threaten the economic recovery, and could then have spillover impacts, obviously, to financial stability. The second risk on the top row relates to cyber attacks on key financial infrastructure, a risk that we have elevated in the SARB from medium to a high likelihood as a result of increased activity in the space over the last 6 to 9 months. The third risk that we consider high likelihood is slow and inequitable GDP growth. And we've spent a lot of time in previous financial stability reviews essentially elaborating on the interconnectedness between the macroeconomy and financial stability outcomes. Under medium likelihood risks, we list the rapid tightening of financial conditions. Here, as advanced economies start to recover from the impacts of the pandemic and start to withdraw some of their accommodative monetary policy measures that they had put in place, tightening of financial conditions is likely to happen. But however, if this is done in an unstructured manner or an unexpected manner with any types of shocks to the system, this can result in rapid tightening of conditions. And there are a number of channels through which that can have an impact on financial stability. The second risk relates to material increase in government debt, a risk that we have moved from the high likelihood to a medium likelihood level, even though it presents the financial system with a high level of vulnerability. And this is as a result of improved fiscal outcomes over the past 6 months. A detailed exposition of these risks was contained in the previous financial stability review released in May. And finally, we have a medium likelihood assigned to risks stemming from climate change, and those speak specifically to physical and transition risk and their impact on the financial sector. Another tool that the Reserve Bank uses for identifying emerging pressure is what we call the financial stability heat map. Here, a number of indicators are condensed across 7 sectors to provide a visual explanation of where potential pressures are emerging from. In addition to the obvious pressures coming from the government sector from high debt in that space, we also note over the past several months slight increases in pressure in the non-financial corporate sector as well as the household sector. So shifting our attention to the macroeconomy, the South African economy, as we know, contracted by 6.5% or 6.4% rather in 2020, whereas the emerging market average was 2.2%. And whilst several economies worldwide have already reached pre-pandemic levels of output, South Africa will only reach pre-pandemic levels of output sometime in 2022. And as the graph on the left demonstrates, we're lagging far behind the world average in this regard. So despite the fact that the outlook has improved, the domestic outlook rather has improved over the past 6 months, we're still some ways behind how the recovery is taking place around the world. Investment has also slowed considerably to a multi-decade low as a percentage of GDP as is exhibited by the right-hand graph. And this also raises concerns about the durability of the recovery and about future growth prospects in the economy. On the left-hand side of this chart, what we're showing is how credit was extended to various sectors around the world, in looking at extension to general government, households, and non-financial corporations. Whereas on the right-hand side, what we're showing is exactly what happened here in South Africa. And what you'll see is that bucking the normal trend around the world, credit extended to households and non-financial corporations has not increased in the manner that has happened globally in South Africa in any case. Other than general government, household credit has only increased very slowly over the course of the last couple of years, and non-financial corporate credit has actually declined slightly, an issue that was also mentioned by the governor recently. However, focusing on the households, the level of credit extended to households and the fact that it is starting to slightly increase is something that we need to pay very careful attention to. Unemployment is at record highs, having just gone over 34%. And real household disposable income is yet to reach pre-pandemic levels, as is demonstrated by the middle chart here. Simultaneously, household debt as a percentage of GDP, a ratio that was normalizing ever since the financial crisis of 2008, has started to increase slightly again. And if conditions in the employment market and around disposable income persist, we may foresee that this ratio continue to increase over the coming years. Which may be ultimately why we're seeing default ratios in the banking sector's retail portfolio start to inch towards a historical high. So on this graph, we see that defaults have almost approached 8%, which would be actually the highest level on record. And there's been a significant increase from the beginning of the pandemic up to this point. It's also important to note that these are defaults over and above what was allowed for around typical COVID-19 restructures, according to Directive 3 of 2020. So that allows us to transition quite nicely into a discussion of financial sector resilience, as well as some of the outcomes of the Reserve Bank's 2021 stress tests. So if we start with banks, where the recovery has been quite encouraging, the left-hand chart shows the collapse in profitability that happened over the course of the first half of 2020, and how that has since recovered to what starts to approximate pre-pandemic levels of profitability. This recovery has been driven by a very significant slowdown in credit losses made by banks, as well as a relative normalization of the levels of income to pre-pandemic levels. Meanwhile, return on equity and assets for the banking sector are also bouncing back quite nicely over the course of 2021, although they have not yet quite reached the levels that they were at before the pandemic. In another indication of a return to normalcy, the graph in front of you shows the volume of COVID-19 loan restructures, or what we refer to as Directive 3 restructures, that has declined from a peak of just over 600 billion roughly a year and a bit ago to what is now just over 60 billion in August of 2021. The volume and value of these restructures has declined to the point that the Prudential Authority will actually be phasing these restructures out over the course of the first quarter of next year. So if we shift our attention slightly, and whilst we're talking about the banking sector, we have an opportunity to unpack what is contained in Chapter 2 of the Financial Stability Review, which speaks to the common scenario stress test of the banking sector that was conducted by the South African Reserve Bank over the past several months. This exercise contained two scenarios, a baseline scenario and an adverse scenario, the latter of which simulated a double dip recession, which effectively was caused by a significant deterioration of the COVID-19 conjuncture both domestically and globally. The scope of the exercise covered the 6 largest domestic banks, which we've designated as systemically important financial institutions, and accounts for roughly 92% of total banking sector assets. Unlike the exercise that the South African Reserve Bank conducted last year, the common scenario stress test is conducted as a bottom-up stress test, which is then complemented by a top-down assessment conducted by the SARB. What this means in practice is that this exercise is conducted bottom-up by banking institutions themselves, and then complemented by an assessment from the regulator in a top-down fashion. As was the case in previous exercises, the impact on bank capital is comprehensively assessed both from a supply and from a demand perspective. Capital supply is assessed for the impact on profitability, income, operating expenses, and credit losses, whereas capital demand is assessed from all material risks that exist inside the banking book. The full scope, coverage, and assumptions of the exercise are included inside the Financial Stability Review, but there are a couple of key assumptions that I should probably outline now. The first of which is that the exercise did not allow for any new COVID-19 loan restructures, that any credit exposure that went into default was not allowed to be then cured back into a performing status, that no management action was allowed as part of the results, and importantly, any unappropriated profits at the starting date were excluded from the results of the stress test. The SARB's 2021 exercise also included 2 fairly novel elements. The first of which was an assessment of liquidity buffers under the 2 scenarios that we've just outlined. And these liquidity assessments were done in a path-consistent way with the solvency outcomes as we start to investigate solvency liquidity feedback loops. And the second element that was quite new for us was an experimental climate change risk add-on, which was done over and above the adverse scenario. And some details of that are shared in box 2 of the Financial Stability Review. So naturally, one of the first questions around any stress test is the scenario, the adverse scenario that was used in that exercise. And on this slide, we're just going to unpack very briefly what was the depth of the contraction in real GDP as part of the scenario. And the first thing you'll notice from the left-hand chart is that the contraction in GDP under the adverse scenario was not as significant as what was experienced in 2020. The reason for this is that the Reserve Bank typically conducts stress tests trying to explore tail risk, or rather, the most severe types of outcomes. However, the current exercise presented an interesting challenge in the sense that we were already experiencing a very difficult macroeconomic environment. And so we were effectively asked to produce what was called a tail of the tail scenario. So if you look at the right-hand graph, the third bar shows the depth of GDP contraction under the 2021 adverse scenario. And whilst this is not as severe as some of the previous stress tests that the SARB has undertaken, if considered in conjunction with the events of 2020, the total impact on the economy is probably more severe, or is in fact more severe than any other exercise that the SARB has undertaken. In fact, As a result of this scenario, if it were to play out, by 2023, GDP would only reach economic output levels last seen in 2011, which would equate to a loss of roughly 12 years worth of GDP output growth. So if we turn our attention then to the main results from the exercise, and what we have in front of us are the weighted common equity tier 1 capital adequacy ratios. And the takeaway message is that banks remain adequately capitalized in both scenarios, with comfortable capital buffers to the prudential minimum, represented by the horizontal line that goes through the entire graph. Weighted CET1 ratios deteriorate from roughly 11.7% at the reference date to somewhere around 10.3% at the lowest point in the adverse scenario in the bottom-up assessment. Over and above what we're seeing here, as I mentioned, unappropriated profits were excluded from the exercise, and were we to allow them to be included, that would further improve the capital adequacy position of these institutions by another 52 basis points. So whilst banks remain very resilient and adequately capitalized in both scenarios, it is worth noting that there is a slight deterioration in their solvency position, as is to be expected under the adverse scenario. And this is driven predominantly by changes in profitability. So the right-hand 3 bars show the profitability of the banking sector in the adverse scenario. And we note that they're significantly lower than in baseline, which is in line with our expectations, but the banks still remain profitable throughout the 3-year horizon. The decline in profitability is driven predominantly by deterioration of credit asset quality and tighter interest margins, which translate into higher credit losses and lower net interest income. And whilst on the topic of deteriorating credit asset quality, over the course of the 3-year stress horizon, non-performing, or the stock of non-performing loans effectively doubles up to around 380 billion rand. And the ratio of non-performing loans to total loans and advances increases to around 9.5%. This is in line with our expectations. But what is of course of interest as well is the deterioration of NPLs under the baseline scenario as well. Under the baseline, NPLs moved from a ratio of around 5.5% up to just short of 7% by the end of this 3-year scenario. And that suggests to us that the full impact of the 2020 pandemic and the associated economic outcomes has not been felt in its entirety on bank balance sheets just yet, and that there may be future losses still to be realized. As I mentioned, the stress test also included a solvency to liquidity feedback mechanism across both scenarios. Liquidity buffers were assessed against the regulatory requirements of the liquidity coverage ratio and the net stable funding ratio, as well as a cash flow analysis. And details of all 3 are included inside the financial stability review. What we have in front of us right now is a demonstration of the outcome of the aggregated liquidity coverage ratio. And whilst the right-hand side speaks to the adverse scenario, we note that as net cash outflows increase under the adverse scenario, banks remain comfortably able to the ability remains to maintain a LCR of about 100% at all times fairly comfortably. So if I can quickly turn to the non-banking financial sector just before I conclude, starting with the insurance sector, there's also a similar picture of resilience coming through in this space. Insurers have continued to show growth in premiums written year on year across both the life and non-life sectors, which is demonstrated by the graph on the left-hand side. And the graph on the right-hand side shows us that profits have appeared to stabilize quite nicely over the first half of 2021, although they may not have quite reached pre-pandemic levels just yet. All of this translates into a sector that remains very well capitalized. Here we are showing a distribution of solvency capital requirement cover ratios, or as we call them, SCR cover ratios. And we note that a very small percentage of firms are unable to meet this prudential requirement as of June of 2021. In the life sector, that number stands at just about 3% of total institutions in that space. And that number is a lot smaller than the non-life space, with only about 1.5% of institutions unable to meet this specific prudential requirement. And finally, I would like to briefly just look at the money market fund sector. The graph on the left-hand side shows the exposures per sector between banks, non-financial corporates, and the government. And what's interesting there is that over the pandemic period, money market funds have increased their exposure to the sovereign as they search for yields in this market. And as government bonds have presented quite an attractive alternative to some of the other assets in their portfolios. Whilst this is not a risk in and of itself, it does show a continuing of the trend of interconnectedness between the sovereign and the financial sector, and demonstrating that the nexus between the financial system and the sovereign is not limited just to the banking space. On the right-hand side, we show assets under management and the net inflow of these assets over the course of the last several years. And whilst assets under management from the money market fund sector have continued to grow, over the first 2 quarters of this year, that number appears to have fallen a little bit. However, it's important to note that this is actually being driven predominantly by the closure of the largest money market fund in South Africa. Once we strip out the impact of the closure of that money market fund, the second quarter of 2021 actually shows an increase or an inflow of a further 33 billion into this specific sector. So finally, I'd like to move on to a quick update of the policy responses from the South African Reserve Bank and the Prudential Authority. Previous financial stability reviews have detailed the range of actions undertaken by both the South African Reserve Bank and the Prudential Authority to mitigate the impact of the pandemic. And whilst most of these policies have returned to normal due to the resilience of the financial system, there are a couple that still remain in place, namely an easing of the liquidity coverage ratio requirement and the differentiated regulatory treatment of loans that have been restructured as a result of COVID-19. However, given the normalizing conditions, the Prudential Authority has recently issued directives around the phasing out of these remaining policies over the course of the first quarter of 2022. Finally, the South African Reserve Bank's Financial Stability Committee has maintained the countercyclical capital buffer at 0%. So to conclude, the Financial Stability Review demonstrates that the financial stability outlook is improving in tandem with the economic outlook, and as financial institutions begin to return to pre-pandemic profitability. However, we must not lose sight of residual risks relating to elevated debt levels and debt servicing costs, the durability of the economic recovery, and the ever-present risk posed by the sovereign nexus. Furthermore, South African Reserve Bank's stress tests of systemically important financial institutions concluded that these banks have adequate adequate solvency and liquidity buffers to withstand a double-dip recession scenario. Finally, and as always, the SARB will continue to closely monitor developments in and around the financial sector and will adjust policy as and when necessary. And with that, Yolanda, thank you very much. I'll hand back to you.
Thank you so much, Vafa, for that great and fascinating presentation. I'd like to just introduce our panel members. We have Deputy Governor Kuben Naidoo, we have Deputy Governor Rashad Kassim, we have Deputy Governor Fundi Chazibana, we have Dr. Nicola Brink, and of course, Vafa, our presenter, will also be available for questions. Governor, I will be asking the questions. I will try and ask 4 questions at a time. If we don't have 4, I'll ask those questions that I have, and then you can just answer or allocate them as appropriate. So the first question that we have is from Lindley Donnelly from the Business Day. And Lindley's question is as follows. Please, can the bank give any details on the work being done around policy options to address the banking sovereign nexus? The second part of the question is, how does the bank expect a sudden tightening of global financial conditions to aggravate or worsen South Africa's banking sovereign nexus? Governor, the second question is from Anthony Silberberg from Artex Fund. And Anthony's question is that we need currency stability to help economic growth and build confidence. Why is the rand slipping so badly right now? And what is your prognosis for the medium term? That's all the questions I have at the moment, Governor. Can go ahead and answer those. Thanks.
Thanks very much. I mean, the work done on the sovereign and banking nexus, it's we are doing work here at home, but the main work is being done through the Basel Committee on Banking Supervision. What it has to do is that historically, government debt would be allocated a zero risk weight on the balance sheets of the banks. And since we have had some countries that have defaulted, the question started to come amongst the regulators that we have got to be re-looking at government debt differently, and that the risk weight cannot be zero. And you ask the question, how would the tightening of financial conditions affect the sovereign banking nexus? It's mainly through a repricing channel. The banks are, like everybody else who are holding financial assets, have got to mark these assets to market. And to the extent that the banks are sitting on large amounts of government bonds, when there is a movement in the price of bonds, which has got an inverse relationship to the yields on the bonds, and in this case, thus, if financial conditions tighten and capital starts to flow from the emerging market to the advanced economies, as the advanced economies tighten, there will be a repricing of financial assets. And so bonds would also be repriced. And when that repricing takes place, the banks are going to have to mark to market those losses and charge them against their income statements. So depending on whether that move is a smooth one or an abrupt one, and the extent to which the repricing has taken place, it could have a significant impact on the balance sheets and income statements of the banks. And that is how it goes. And the last question, I forgot the name of the guy, he talked about currency stability. Well, it is always useful to have a stable and competitive currency. But for us, when we talk of a stable and competitive currency, we are not talking of a currency that does not move as fundamentals change or as market conditions change. But we are talking of a currency that over time is stable and is aligned to the differential in inflation rates between South Africa and its major trading partners. So when we talk of stability as a central bank in the currency market, we are talking of the real effective exchange rate rather than the daily gyrations that you will see in the spot foreign exchange market. So that then says to us, it is important for the South African inflation rate to be comparable with those of peer countries so that we actually maintain that currency stability and competitiveness. I don't know if other members of the panel want to add anything. I see nothing. We can take more questions.
Sorry, Governor, just there's two small points. The first is that the big banks in South Africa do not have a zero risk weight for government bonds. The big banks in South Africa use what we call a modeled approach. Banks on standardized approach, on the standardized Basel Committee approach, have a zero risk weight, which are mainly the smaller banks. The bigger banks in South Africa use models, and all the model banks have a non-zero risk weight for government bonds. And as the country gets downgraded or as credit risk goes up, those weights do change automatically. So there isn't a zero risk weight for the big banks. Chair, just the second point on the currency is that if you take the period post the initial COVID shock, the Rand has largely tracked commodity prices, largely with some exceptions. When commodity prices were rising, the Rand was doing pretty well. And since commodity prices have fallen in the last 3 or 4 months, an index of commodity prices, the Rand has done less well. There may be some other factors that would influence the minutiae, but in the main, in the last year, that's been probably the single biggest driving factor around the current situation. Thanks.
Thank you, DG Kuben, and thank you, Governor, for those responses. I've got two more questions. The first one is from Nicola Wayma. The question is, given the anticipated rise in NPLs under the base case, what is your expectations around the impact of the normalization of domestic interest rates on NPLs? The second question is from a Facebook user by the name of Zamantuli. And the question is, could you comment on the necessity to teach on climate change, especially about how it can impact them in terms of its impact on their finances?
Can you repeat that last question?
So the question is, could you comment on the necessity to teach people on climate change, especially about how it can impact them in terms of their finances?
Is that it?
That's it for now, Governor.
Okay, thank you very much. I'm going to leave the NPLs to Mr. NPL himself, DG Naidu, and talk about the climate change and finance. Our approach to climate change as a central bank is from two important perspectives. The first has to do with what climate change means to future production patterns. What does it mean for future shocks that might impact on domestic price formation, and how we are going to have to respond to those shocks? And that is a constantly going on discussion. We have seen extreme weather patterns of floods, of droughts, and so forth, and they have impact on food prices and so forth. And the approach we normally take is, oh, this is a shock, and we would wait and see whether there are second round effects and so forth. But if there is persistence in the shock, you might have a situation where prices actually rise permanently and could actually feed into the de-anchoring of inflation expectations. That is the one aspect. The second aspect has to do with our financial stability responsibility. And it has to do with identifying what are the risks coming from climate change and what impact would they have on, firstly, the individual financial institutions, which is why this initial work that we had done had to stress test the institutions. And secondly, whether the impact could actually be on the entire financial system. So with respect to the individual financial institutions, it would have to do with how individual financial institutions are exposed to particular risks, but this could also be the risks that are impacting on the entire financial sector, and if they do, then might pose financial stability risks. We are busy honing our tools. We are leveraging on our membership of the Network for the Greening of the Financial Service, and on the work on the task force on climate disclosures, so that we can get a better understanding of the risks that are attendant to the financial sector with respect to the climate change. So that is how we think about it. Teaching, I suppose what we should be happening, I guess the Department of Environmental Affairs talks about climate change and so forth. The point here is climate change is a reality. We are living in one planet, and you can't say that it is for somebody else to worry about it, because we lose this planet, it will take all of us with it, and it is important that we save this planet.
Thanks, Chair. Chair, on the non-performing loans, let me start off, and I think Vafa can come in on some of the details because they would have covered some of these aspects in the stress test. So when interest rates go up, two things happen. The banks have something called an endowment effect, right? Effectively, they charge interest on loans, and these loans reprice when interest rates go up. So the banks get a benefit in the form of higher revenue when interest rates go up. But of course, the higher that interest rates go up, the more likely people are to be able to unafford those loans or not afford those loans. And so you have a rising rate of default. In a normal cycle, those things largely even itself out. Right? As interest rates rise, in a modest cycle in South African history, if I look back, with the exception of 1998, if I look back 30 years, modest interest rate hiking cycles are 200 to 300 basis points. You have an increase in the endowment effect, which is good for banks, offset by an increase in non-performing loans, which is bad for the banks, and it's largely evens itself out. You could then have an adverse effect like the 1998 increase in interest rates, which went up to, I think the repo rate went up to 21, 22%. In that kind of a scenario, yes, the increase in non-performing loans outweighs the positive endowment effect, and banks can get into significant trouble. And we saw between 1998 and 2002, lots of banks got into trouble. Sambo being the biggest, but lots of banks got into trouble during that period. So Chair, our base case scenario is that in a modest, expected, normal interest rate cycle, there will not be an undue or adverse impact on banks because the rise in non-performing loans will largely be offset by the increase in the endowment ratio. When banks give loans, they have to stress test their customers. So can you afford to take this loan at the present interest rate? What happens if interest rate goes up 200 to 300%? Will you still be able to afford that? We look at those metrics. We also look at something called loan to value ratios. And Chair, at this stage, we're reasonably comfortable that in a normal cycle, the banks will be able to manage this fairly safely. Vafa?
Thanks, Deputy Governor. I think just to add a couple of points. The first is that stress tests are a simplification of reality, and it's important to understand their design each features to be able to take implications from the outcomes. And the one that I mentioned was that any loan that falls into NPL status during a stress test cannot actually come back into a performing status, which under the course of normal behavior would actually happen. So some of these loans would actually return to performing status and they wouldn't remain in that NPL bucket. So that's the one thing. So the channel in the stress test is one directional. It doesn't allow for recovery of some of those assets, and that may result in a reported NPL ratio that's more of a ceiling rather than an expectation. And the second one is to just bear in mind that the baseline scenario did actually allow for roughly 200 basis points of monetary policy tightening. So the scenario was based on the MPC baseline that was put out in March of this year. And so that roughly saw the repo rate moving from what was then 3.5% to roughly 5.5%. So there are those factors also at play in the outcomes of the stress test. And it's important to look at them in that context when drawing any inferences therefrom. Thank you.
Thank you, Deputy Governor Naidoo and Vafa for your responses. Governor, we don't seem to have any more questions at this point in time. There was, however, a virtual media lockup earlier on, and that was quite well attended by the media and very interactive. I suppose that would then mean a lot of their questions, the media questions, were attended to during that session. So I think that is it from the Q&A. Thank you for a very interesting Q&A session and some good answers. Governor, back to you. Thanks.
Well, I suppose with such a resilient financial sector, you wouldn't have expected to be lots of questions. But thank you very much all for your attendance, and the staff of the SAP who had put together the publication and the presentation. Thank you very much. And for all of you, have a restful festive season. We will see you again in the new year, somewhere in January with the first MPC of the year. Thank you very much. The session is adjourned.